All right, folks, welcome to another installment of Charts to Watch, which will be our Sunday video, 9/22/24. Now, you might be aware, because I told you in advance, that I got eye surgery and my availability will be limited, and I cannot do a lot of time looking at the computer and making the videos, unfortunately. But before the next week begins, I want to leave you with some outlook. What I see in the charts at least, and then we can carry the conversation again tomorrow when we do the weekly recap. I think by tomorrow I'll be ready and we'll do a long, nice video for you covering everything. The macro, the Fed decision, the implications in the economy, and the markets. Everything will be discussed in tomorrow's video. But folks, once again, I want to begin by apologizing, at least to some of you who were not aware that I'm going to be gone for the week or my availability will be limited. Even though I communicated all of this ahead of time, folks. But again, you get these nasty messages and folks being angry and all of that, even though I told you in advance that my availability will be limited in my ability to see. I can't help you if I can't see. In any case, folks, I'm going to extend the apology either way for the lack of availability. But the good news is I'm going to be more available this week and we'll do a lot of work. With that out of the way, before we begin this conversation and talk about the charts, we'll do the weeklies, of course, because that's what really matters. Let's talk about 3 important points. Point number 1, the Federal Reserve cut rates by 50 basis points, but the response by the bond market and the dollar came out surprising to the majority of market watchers. We've seen bond yields ticking higher. We've seen the dollar also ticking higher a bit. Now, would that be the lasting impact of the Federal Reserve cutting rates by 50 basis points or perhaps more in upcoming meetings? I think the answer is clear, that the dollar and bond yields should be heading down in the long run if we see more and more cuts. But in the meantime, the reaction that we got is important. It's going to implicate the rotation. So that's point number 1. We have to understand the reaction by the dollar and the bond market said something important, and it's going to have an impact on the charts. Number 2, a lot of folks have to be really careful about the assumptions they're making based on Thursdays and Fridays sessions. And I say that because there is a lot of distortions, and it might not be the final reaction of the market based on the cuts that we got by the Fed. You might actually see the real reaction in this upcoming week. And I say that because Thursday, Friday, we had 2 important events. Number 1, one of the most important OPEX in history. That's options expiration. We're talking about trillions and trillions of dollars. And we know that usually September is more important than any other OPEX. And the reason is September, the seasonality is bad, so there is pre-positioning in a lot of puts that are bought beforehand with the monthly expiration of September. So when you see the market on Thursday moving higher, it is reflecting a reaction to that kind of positioning. And of course, a lot of folks after that kind of reaction, they begin buying calls, assuming that the market is going higher. And then the market maker surprises them by closing the market flat to negative the next day, to make sure that those who bought the Johnny-come-lately call options with the weekly expirations are going to make money. And the other factor that could have distorted the reaction is the fact that we have the rebalancing of the S&P 500. And of course, we know that certain names will be added like Palantir and Dell, and they have to be bought beforehand. But these are all smaller names. The most important name was Apple, and that's going to be a market mover. In my assessment, we've seen a rebound in Apple because folks were buying it because of the rebalancing. You got to remember, Warren Buffett dumped a lot of shares of Apple. Now that we have the rebalancing, they have to buy Apple again by default, just to have the same weighting as the S&P. We're not talking about Berkshire Hathaway, of course. We're talking about asset managers. Since now we have more supply of Apple shares, it has to be picked up to reflect the weighting in the S&P 500. But you've seen the last few minutes or so of trading that Apple flushed down in a big way, closing negative. The name was up by more than 1% earlier in the session. What is the message behind all of that? Specifically when we get news that the iPhone 16 release is disappointing, that the lines at the stores for the release were shorter than usual, shorter than in prior releases. It tells you right off the gate that we could see an opposite reaction in an aggressive way in the stock of Apple the very next week, meaning beginning tomorrow. So these are important things to keep in mind. The Thursday, Friday could be a lot of distortion because of OPEX and the rebalancing of the S&P 500. Now, we talked about point number 1, which is the reaction of the bond market and the dollar, which was surprising to most market watchers. We talked about point number 2, which is the distortions by OPEX and the rebalancing of the S&P 500. The third point I want to make before we begin this coverage right here. You can make all of the assumptions you want to make about the rotation. oh, the Fed cutting 50 basis points, that's going to be good for technology, or good for the small caps, or good for the hotels, or good for this and that, or bad for this and that. But your assumptions can be made prematurely if you're chasing the day-by-day action in a period of time when the market is trying to find its identity. Does it continue in the bullish trend that's been going on since late 23? Or does it change the direction and begin building a bearish wave? And in this kind of battle, where the market is still making up its mind, if you're trading in the short term, if you're trying to figure out the market move day by day, or weekly expirations, or 2 weeks from now expirations, you're going to lose your mind because you have to get it precisely right. You'll see 1 week where the market is down big, and you'll see certain positions getting absolutely annihilated. And then you'll see the opposite reaction the very next week, where we see the market going up big, and certain positions that were assumed the week prior are now getting annihilated. And therefore, before you make any assumptions about the rotation or any short-term plays, I suggest that you take a longer horizon view, and this is why we're doing the weekly charts. And despite what you and I might think about, oh, the rotation is going to be good here, bad there, it's better to let the charts to at least take a look at them from a weekly standpoint, not the 3 minutes, not the 5 minutes, not the hourly. That a lot of folks are making a mistake in looking at, and they will be left by the wrong impression. And they'll make assumptions and bet based on the wrong impression. But the weekly charts tell a story. And we have to listen to what these charts are saying. If there is a rotation in the market because of rate cuts, usually favors the laggards, not the stuff that went higher in anticipation of the news. Because we always have the phenomenon of sell the news, and something else is bought after that. So with that setup out of the way, let's look at these charts one by one. I divided them based on 3 categories. The most important, of course, big caps and technology. We want to see what these guys look like one by one. They will want to do risk on because the assumption that most of us hold with 50 basis points cuts, that should be good for risk on. What are the charts saying though? And is it binary? Is it black and white, where you look at risk on and everything looks the same? Or do you have to do the picking? That's really important. And we finish with the third category, which is risk off. Risk off been the leader of the market since the month of August. Does it continue to be the leader, or does it become a victim of a rotation? Let's begin with the big caps and tech. And I'm going to begin with the XLK, the technology ETF, a representative of the big caps. What do we see right off the gate when we look at the weekly chart, say in the MACD indicator? Do we have a wave that is losing momentum? Yes, it's been losing momentum since July, where we've seen the top in many of these names. The question now, is it improving enough to say that we're going to have a correction in this wave where we'll go back to more upside momentum or not? Looking at the MACD right now, it shows that it's just a rebound, but we are still in bearish momentum. The white line is below the average line in blue, and we see red impressions in the histogram, and there is no indication whatsoever, looking at the chart right now, that that's over. Furthermore, when you look at the vortex indicator, we're going to expand this a little bit here so we can see it. You can see that it's a battlefield. The market, the XLK in this case, is trying to find its identity. And it appears that the bearish momentum is increasing, and it's about to take over the bullish momentum. The bearish in red, the bullish in blue. So again, is there a definitive answer based on the 2 indicators we just talked about, the MACD and the vortex? The answer is no, there is no definitive answer, but it leans bearish. What more can we find in this chart if we look at the candlesticks again? It looks that we have a tension pattern. We can call it a triangular pattern. We kind of closed above the upper boundary of the triangular pattern, but it's not definitive yet. You can make a case that we're going to break to the upside. You can make a case that we go down in this upcoming week based on perhaps a lower high once again. And the last observation we have in the charts based on the candlesticks is we got a trend line, and the trend line hasn't been broken yet. We got a breach below, which is usually a warning sign, but we haven't closed the week below. So again, looking at the XLK all in all, which case still has the upper hand? The answer is the bearish case. Is it overwhelmingly though? Is it, let's say, 80-20? Is it 90-10? Of course not. I would say maybe 60-40. But like I said, folks, you have to dig down into the components of the XLK and see which charts are looking good, which charts are looking bad. Because this is going to be a period where we have to pick. There's not going to be a black and white answer. So let's begin with the biggest one in the XLK, which is Apple. Here's the weekly charts. nothing by me here, just the chart as it is, the weekly chart. What do we see in the observation of the MACD indicator in the weekly chart? Momentum has been bullish, but it's running out of gas. And it's just a matter of time before we see a shift in momentum from bullish to bearish. Now, can we extend the bullish momentum a little more? Sure, that's a possibility. That's a risk if you're taking a bearish stance right now, if you're timing it right now. So let's gather more evidence. What do we see on the vortex indicator? We see the red line accelerating, firming up, moving higher. But we see the blue line, the bullish, losing momentum and moving down. So the bearish momentum is beginning to creep in, no matter if you look at the MACD or the vortex indicator. Now, you look at the RSI, we're also closer to the overbought territory. What else can we extract from this chart? We have a sloping line of resistance, and we haven't closed above. So we cannot definitively say that the bullish momentum will be extended. What else can we see? We know that we have really strong support, really strong resistance at around, say, 214. Meaning, if we close a week below 214, it'll most likely be a definitive answer that Apple is heading down to revisit the lows perhaps sub 200. And if that is the case, then you'll know for sure that we're going to get a confirmation in the MACD indicator and the vortex as well. So Apple right now, looking at it from the weekly chart, still bullish, but the bearish risk is creeping in, and it is on the verge of reversing. So if you want to enter Apple right now as a long, you need that confirmation. You need to see a closing above the sloping line of resistance. Otherwise, the opportunity in this chart right now is a reversal play, because that's what it's leading toward at this point. The risk is leaning toward a reversal from bullish to bearish. What about Amazon? Weekly chart, once again, I don't have any markings, any notes by me, just the charts as it is. What do we see here in the MACD indicator? It's been under bearish momentum that is now shifting toward bullish momentum. You can see it in the MACD, the red impressions in histogram, the columns are getting shorter. They're about to reverse. The white line is about to cross above the blue, the average, which we call a bullish reversal. You look at the vortex indicator, it looks like a battlefield right now, but if we had to make a bet, based on the look that we have right now, you probably bet that the blue line continues to firm up and the red line will perhaps continue to descend down. We go back to the candlesticks of Amazon. What do we see here in terms of the trend line? Remains bullish. We haven't broken that yet. There's always the risk if we reverse right here and Amazon begins to trend down. It'll be a confirmation of a lower high, and that means that the trend line will be broken. Absent of that, based on the evidence that we got so far, the trend line, the change in momentum indicators in the weekly chart, and furthermore, we know that 190.60 has been resistance before in prior weeks. We've closed above that. The collective evidence suggests that Amazon is probably reversing from bearish to bullish in the weekly chart. That means it is one of the strongest among the big caps. But if we have to label it, it is shifting from bearish to bullish. That's the risk. In Apple, it was the risk of shifting from bullish to bearish. Interesting. So when you look at the XLK, it gives you one side of the story. You dig down in the individual components and you get a different answer. Let's do Google. What do we see here in the weekly chart? Again, nothing by me. Right off the gate, when we look at the MACD indicator, it is under bearish momentum, but we have no signal whatsoever that this bearish momentum is shifting toward bullish. At least not right now. You can make a case that perhaps the bearish momentum is topping and it's about to reverse. You can see that in the RSI firming up a little bit. The closing that we got for the week, which was positive. But for now, looking at the MACD, looking at the vortex, the predominant momentum remains bearish, not bullish. We go back to the candlesticks again and we look at the trend line, not broken yet. So if there's a consistent theme between Apple, XLK, Amazon, and Google so far, it is the fact that the trend line, the bullish trend line, hasn't been broken. So yes, we have bearish momentum going on, but the trend lines are not taken out yet. Keyword yet. So that's going to be our bearish confirmation in the weekly. If we take the trend line, then Google already topped and it's going to head down from this point on. We will see the bearish momentum accelerating and moving higher. Now, we know that we have prior reactions in or around the level of 164. If we close above for the week, then there is a stronger case that the bearish momentum has already topped. It is reversing and we have the birth of new bullish momentum. But you gotta close the week above 164 before we have this confirmation. So again, what is the risk here for Google? The risk is it's been under bearish momentum. It might shift toward bullish momentum. Keyword might. Let's do Microsoft. Again, weekly chart. No notes, no markings by me. What do we see in the MACD indicator? Under bearish momentum. So the wave is still bullish, but it's weakening. It's about to go down the zero line. So we know that we've been under a weakening bullish wave that's about to reverse. Right now, within the wave itself, the bullish wave itself, we are under bearish momentum. What else can we see if we look at the vortex indicator, expand that a little bit here? You'll see a battlefield. We can make a case that the red line is going to accelerate. You can make a case that no, the blue line is going to accelerate. So we have no definitive answer when it comes to Microsoft momentum. Let's go back to the candlesticks and look at the trend line. In the case of Microsoft, unlike Amazon, unlike even Google, the trend line has been broken. And we're now just in a struggle whether Microsoft is going to recapture the trend line or not, meaning that the trend line becomes really important. If, let's say next week, we begin to trend down, and we abandon any attempt to recover the trend line, then the likelihood is you will see the MACD extending the bearish momentum, ending the bullish wave, and that's going to be a major, major deal because we've been in a bullish wave since 23. Ending the bullish wave is a major deal for one of the most important names, if not the most important name in the market right now. Furthermore, we'll have an answer in the vortex indicator that we will see the bearish momentum, the red line accelerating, the bullish in blue turning down. What if we close above the trend line though? Then you got your answer. That sure, Microsoft is doing a recovery. And again, if it's one of the most important names in the market doing a recovery, then you probably see a recovery in the big caps and the market all in all. But there's another important indicator we have to look at. Say we have a rejection of the trend line, and Microsoft begins to trend down. When do we say for sure that the top is already in for Microsoft and down we go, that we have a bearish momentum? And they will say at that time that Microsoft is in a bear market. It's down 20%. But you would have spotted it ahead of time. That would be your 50 weeks moving average, the blue line. You take that out, you close below that number. Then you got a confirmation that the bullish wave in Microsoft is over. So again, one of the most important names in the market, but it is, believe it or not, more bearish than Apple, more bearish than Amazon, and more bearish than even Google, which at first glance, you might say that Google is the weakest, but it's actually Microsoft. Because you gotta remember, Microsoft was the first one to play the AI hype. The rest of the other names, they caught up later. Now, what about another important name in big caps? How about Meta? This is the weekly chart. Again, the chart as it is, no markings, no notes by me. What do we see in this chart? Obviously, and I've been saying this for a few weeks now, that Meta remains the best looking charts in the big caps right now. And you see that right away if you look at the MACD indicator. It's been under a bearish wave that began all the way since, let's say, June, July. But this bearish wave in the MACD, all what it gave us is just consolidation, which usually that's a bullish signal. That once the consolidation is over, once the bearish momentum already plays out, we see the release of all of that energy. And now maybe perhaps we're in the beginning stage of that release in the energy. You see the MACD firming up, about to give us a change in the histogram from bearish, red columns, into green columns, aka bullish. Let's do the vortex indicator. What do we see here if we expand that? We're already in bullish momentum. So you look at Microsoft, you look at the Apple, you look at Google, it's a battlefield. There is no definitive answer. Even the XLK, it's the same thing. But then you look at Meta, you see that the bullish momentum is predominant right now, and it's leading. So until it proves otherwise, our assumption should be that Meta remains a bullish chart and perhaps will accelerate that bullish momentum in the days and weeks to come. We go back to the candlesticks again, check on the trend line. The trend line remains intact. We got some resistance at around, let's say, 544.23 before. We've now closed above. All indicators, the candlestick, the trend lines, everything suggests that Meta is the most bullish looking chart among the big caps. So again, it's not a black and white thing. You can look at the XLK or the big caps and not like it, or suggest one thing or the other based on the rotation, that it might be in the big caps, it might be against the big caps. But if you must pick, now you know which one to pick. You pick the easy chart. If you want to go long, the easiest chart to pick is Meta on the long side. The easiest chart to pick against on the downside is obviously Microsoft, or perhaps Apple, if they give you those confirmations. In the case of Microsoft, abandoning the trend line. In the case of Apple, the confirmation in the momentum indicators, the vortex, and the MACD. So we talked about the big caps and the XLK. What about chips though? Let's look at the SMH, the chip component. Weekly chart, once again, no notes, no markings by me at all. What do you see in the MACD indicator? Are we under bullish or bearish momentum? The wave is bullish, sure, but the momentum is bearish. White line below the blue, you see the red impressions in the histogram. You know that we're under bearish momentum. We're getting really, really close to the zero line. We lose that, it would mark the end of the bullish wave that began all the way back, folks, since the year 2023. So it is a big deal if we lose the wave in the SMH. We're not there yet though. Let's look at the vortex indicator. It's been a battlefield, but right now the predominant momentum is bearish, not bullish. The red line is above the blue. Now, of course, all of these are lagging indicators. They're giving you what already happened. Is there a risk of reversal from bullish to bearish? Sure, always. There's a risk of reversal. But right now, is it a close battle, or is the gap big enough to say that we have one dominant theme? And the answer is yes, the gap is big enough to say that we have one dominant theme, which is the bearish theme. So the bulls and chips have the burden of proof to show us that the chips are still bullish and higher we go from this point on. But right now, the bears have the upper hand. We go back to the candlesticks. What do we see here? We see that we have two important lines that have been resistance before. The first one being 239.14, then the other one being the all-time highs in the SMH. Of course, the most relevant one for us right now is 239.14. We couldn't close above back, say, in the beginning of the year. Then we did later on in August, in the rebound that we got after the Japanese yen scare. But that closing failed, and we went back below the line again. The question is, do we stay below? And if we stay below 239.14, then what is the message here by the chart? Perhaps the message is that it doesn't have the energy or the demand by the buyers to push it higher again, to challenge the all-time highs and leave 239.14 behind. And if that is the case, we'll look at the trend line, still intact, but if we fail to close above 239.14 and we see a rejection of a lower high from the month of August, the likelihood is in time, the SMH, the CHIPS index, will be back at the trend line once again. And that will take it below 200, depending on the timing where it's going to get there. So that's really important. But like we did with the XLK, it is important to look at the components of chips, and the most important one, and the leader of all chips, really, they move based on this name. It's NVIDIA. So we look at the weekly chart here. What do we see in the MACD right off the gate? Bullish or bearish momentum? Forget about the wave. The wave above zero, that remains bullish. But what about the momentum within the bullish wave? It's still bearish. You see the red columns in the histogram expanding. They're not really getting shorter to say that we have the reversal from bearish to bullish. Maybe that's going to change this week. But again, the burden of proof is on the bulls, not the bears. The bears got the upper hand right now. Look at the vortex on the weekly chart. Which one is the predominant momentum? The red line. That's the bearish momentum, not the bullish momentum. Is it a big gap as we've seen in the SMH, for example? No. The gap is a little shorter. Things could change. But right now, as I said, burden of proof on the bulls, not the bears. Go back to the chart. Draw the trend line. The trend line is intact. So we know that NVIDIA is the leading indicator for the SMH. If NVIDIA loses the trend line, the SMH will be next. At the same time, we do have a tension pattern if we draw a line of resistance and we have a series of lower highs. Then we're still waiting for a break one way or the other. But we know right now NVIDIA leaning bearish, not bullish. For now, the bears have the upper hand, not the bulls. If we have a break above the tension pattern on the upside and close above, most importantly, then that dynamic will change. But if we break the trend line and we begin to see the vortex accelerating, the MACD heading down towards zero, then the answer will be clear that NVIDIA has already topped and we have further downside to come. So again, does the chip index, including NVIDIA, look as good as the XLK? The answer is no, because in the XLK, I can pick and choose. I can say, okay, I see Google maybe changing toward bullish. I can make an argument that Amazon might be changing into bullish. And of course, Meta remains the most bullish chart that you can still follow. You can also make a bearish case against Apple and against Microsoft. But the chip index looks a lot worse than the XLK. And the leader in the chip index, NVIDIA, the heaviest weighting, doesn't look as good as the chart of Amazon or Meta or even Google, for that matter. So in this battle, if we're going to pin XLK versus SMH, XLK wins. Now, what about the third component in technology, which is the IGV software? Now, you look at this weekly chart, looks a lot better than the XLK and certainly a lot better than the SMH, the chip index. Looking at it from the momentum perspective, if you look at the MACD indicator, are we in a bullish wave? Yes, we are. We're above zero. What about the momentum? It's been bearish for a little while, but now it's kind of changing toward bullish, and it has the potential of accelerating higher. Now, we know that we have the previous high, 69.20 on the chart. That's going to be the burden of proof. If the IGV can close above, then the MACD will certainly accelerate and create new bullish momentum within the bullish wave, and perhaps playing the cup and handle pattern that we talked about before. You look at the vortex indicator. Which one is the predominant momentum right now? The answer is it's the bullish, the blue, not the bearish and red. So right now, when you look at the SMH and back to the XLK versus the IGV, which one looks better? Certainly, without a doubt, it's the IGV. But like I said, folks, when you look at the chart, cup and handle, we're going to break to the upside. Let's buy the IGV. All in, baby. Hold your horses. Because it depends once again on the components. Remember, there's a rotation coming, and you have to look at the individual components based on the weighting. This is not going to be the lazy game of ETFs anymore. This is going to be you picking individual names in what you like. So the highest weighting, once again in the IGV, believe it or not, is Adobe. And Adobe hasn't been looking pretty good recently after the report was out. But the IGV looks pretty good despite Adobe. That's a sign of strength. But the catch is it's been looking strong despite Adobe because Oracle been doing great. So we have to look at these names and see where we stand in the IGV. Let's begin with the highest weighting, Adobe. What do we see in this chart? When you look at the momentum in the MACD indicator, we can see that the momentum is bullish, but it's getting really close to shifting to bearish. When we see the white line going below the blue, we see red impressions in Instagram. Then we look at the candlesticks. We have a tension pattern. We have a series of lower highs and higher lows. And right now it appears that we kind of stop at a lower high without even touching the upper boundaries of the tension pattern, which is considered bearish, by the way. Then you look at the important line of 570, which has been support before, it's been resistance before, as I'm pointing out right here, and we lost it twice in a row. We couldn't close and stay above. It's another bearish sign. If you look at the vortex indicator, you can see clearly that the red line is accelerating, meaning that the bearish momentum is creeping in. Again, from a weekly standpoint, Adobe remains bullish, but there's a high degree of danger that it's going to shift back toward bearish and retouch the trend line of support in the tension pattern, meaning that Adobe is not supportive of the IGV. What about Oracle? Another heavyweight in the IGV. When you look at this chart, it already popped. I think whatever good news we have in Oracle, it's already priced in. It's actually trading and gapping above the upper boundaries of the Bollinger Bands in the weekly chart. So do you really buy this stock at this point? Nobody would do that. Nobody with a technical eye would do that right now. They would actually see it as a chance of a pullback. If there is a recovery within the body of the breakout candle, which was not this week, but the week before, then okay, you can buy Oracle at that point. But right now, the assessment of the risk, looking at the RSI being way overbought in the weekly, the assessment says that at least you'll get a consolidation, if not a pullback. So Oracle, Adobe, not supportive of the IGV. And that means you might buy the IGV, but Adobe and Oracle in the next 2 months or so trade down. And the IGV trades down with them. And we see that the resistance that we talked about, 69.20, remains as a triple top perhaps. So that's something you got to keep in mind. Now, which charts look pretty good in the IGV? Look at ServiceNow, for example. Weekly chart. The momentum is exploding higher. It is expanding the upper Bollinger Bands higher. You see the MACD indicator under bullish momentum that is accelerating. You see the vortex indicator, the blue line, is way ahead of the red line, and it's firming up. The RSI is not overbought yet, meaning that ServiceNow is actually supportive of the IGV. We can see ServiceNow gaining while we see Adobe, Oracle pulling back. So now is better than Adobe and Oracle. And again, we can argue that it's a breakout out of an inverse head and shoulder pattern in the weekly. Let's look at a name like TTD, Trade Desk. Again, expanding the upper Bollinger Bands higher. The momentum is predominantly bullish, not bearish. Whether you look at the MACD, whether you look at the vortex indicator. Way ahead when it comes to bullish versus bearish. The RSI is not overbought yet. So this one can print a little more gains before it tops. What about Ohana, CRM, weekly chart? What do we see here? Here we have a tension pattern. We have static highs and we have higher lows. And then we have the MACD indicator. Momentum has been bearish, but maybe it is on the cusp of shifting toward bullish. The RSI is firming up. The vortex indicator gave us a bullish confirmation this week by opening a gap against the bearish momentum in red. So again, you can look at CRM and say, okay, give me a closing above the previous high, 273.23, and then we have a confirmation of a breakout in this name. So once again, folks, it's not black and white, and the ETF might really hinder your gains, even if you are right about the rotation. So it is imperative that whether you believe that the rotation is going to happen in the big caps or the chips or the software sector within technology, that you pick the stronger names, not the weakest names, and not the names that already priced in the good news. in the case of Oracle, of course. So in software, ServiceNow, Trade Desk, CRM, much better opportunities than Adobe and Oracle. So we've done big cap and technology. Let's move on to the second category that we have in this video, which is risk on. This is where folks are betting on that the Federal Reserve cut by 50 basis points. It means that it's going to be good for risk on. Let's see if those assumptions are merited by the charts or not. Looking at the king of risk on, which is small caps, the IWM. Weekly chart, once again, no notes, no markings by me at all. What do we see right here looking at the momentum? Start with the MACD. Bullish or bearish? The answer is bullish, but not definitive yet. Didn't make up its mind yet. But it could be a pattern of gathering a little bit of energy before releasing it. And you can see it in the candlesticks that the IWM been in a range, defined highs, defined lows for years now. It's only getting out of this range and it's breaking to the upside, not the downside. Furthermore, we also have a tension pattern, lower highs, higher lows. So no definitive answer yet. What you see in the MACD is actually reflected on the charts, that it leans bullish, but it's not definitive yet. You look at the Vortex indicator, it gives us a bullish momentum confirmation, at least for now. So if I had to pick the risk on the IWM, I would say the risk is to the upside, about 70-30, at least from the standpoint that we have right now. But as we've done with the XLK and the IGV and the SMH, we have to do the same thing with the IWM, the Russell 2000. And look at the major component, which is the KRE, regional banks. Of course, regional banks been under a crisis since 23. It's the assets held till maturity. That's the problem. So if the Fed is cutting rates by 50 and it's promising more rate cuts, assuming the economy holds and the Fed is not cutting for the wrong reasons, isn't that good for the KRE, for regional banks or not? The answer is, at least on paper, it appears so. So when we look at the KRE weekly chart, begin with the MACD. Is it bearish or bullish? The answer is, it is bullish. More definitive than the IWM or not? The answer is, yes, it is more definitive. Meaning if I have to pick based on this indicator alone between the IWM and the KRE, I'd probably go with the KRE because it is looking more bullish than the IWM. You see the same reflection, by the way, in the Vortex indicator. The blue line is way ahead of the red line. So between KRE and IWM, KRE looks a lot better, and KRE is actually a leading indicator to the IWM. It has the biggest weighting in the Russell 2000. And we also can argue that we have perhaps a higher low, cup and handle perhaps. And now we're awaiting a close above 59.59 to have a confirmation that the bullish momentum will continue to accelerate. A failure at this point would be devastating for the KRE, but I think it's going to happen only if there is a fundamental reason, such as, oh, the Fed is cutting rates because we have a confirmation of a recession, because the Federal Reserve is hiding something bad about the economy. Now look at another component of the IWM Russell 2000, the XRT, retail stores, zombie companies. The assumption is they benefit from rate cuts, especially big rate cuts, such as beginning with 50. Looking at the weekly chart, what do we see here? On the MACD, it's been under bearish momentum, but we can make a case that it might shift toward bullish. You look at the Vortex indicator, same thing. It's a battlefield right now. No definitive answer, but can we make a case that the blue line is about to cross and dominate the red line? Yes, you can make that argument. We can look at the candlestick pattern. Can we make an argument of a higher low consolidation, or otherwise known as a cup and handle? Yes, we can. What is the confirmation? Closing above 80.10, that we know for sure that the XRT is breaking to the upside. So right now, XRT bearish, but there is a lot of risk that it might shift into bullish. Of course, now we can do this exercise, but it's going to make this video way too long, and the goal is to make a shorter video, not a longer one. But we can look at the individual components of the XRT and pick what we like. So I'm just doing the brush off here, and you can do the digging now that you know how to do it. But again, looking at the IWM, which one has the upper hand? It's the KRE, it's regional banks, then the XRT, which has the potential, keyword potential, of a shift from bearish to bullish. The KRE is already under bullish momentum. When we talk about risk on, folks, it ain't just the small caps. Look at the cyclicals, for example, the ITB, the home construction ETF. What do we see here in the MACD? We have bullish momentum, and it is accelerating. You look at the RSI, not overbought yet. You look at the Vortex indicator. The blue line is dominating the red line. So we have bullish indicators, bullish confirmations across the board. We also have a series of higher highs, as you can see in the trend line. Now, is there a risk that if we get recession news, and consider the news that we got, by the way, on Friday from FedEx, that's not going to stop? Is there a risk that the ITB begins to think, oh, the Fed is cutting rates, but it's cutting rates because the recession is already here. Of course, if that is the case, the ITB will be a horrible holding right now. But I'm just giving you what the charts are looking at right now. And right now, if we have, let's say, a period of optimism about the rate cuts before we get hit with the reality that the rate cuts are happening for the wrong reasons, between now and then, can the ITB register more gains? Yes, it can. Can we make a case that it could reverse too? Yes, we can, because you have sort of a doji-ish candle on the weekly, and it stopped at the trend line, the resistance line. If it begins to reverse this week, it weakens. It's only going to happen if we have recession data. Then we can make an argument that, okay, the ITB kind of priced in the good story from the 50 basis points, and now it's going to do sell the news. In other words, if I'm chasing risk on here, folks, I'd rather be with the KRE. I'd rather even go with the XRT than assuming the risk on the ITB that I might squeeze another 1 to 2% gains, because that might not be the case. The gains might be already squeezed, and down we go from this point on. Looking at other risk-on categories, how about real estate, commercial real estate holdings like Blackstone, BX? Of course, if we have rate cuts, that's going to be pretty good for a company like Blackstone. Question is, it's going to be for the good reasons or the bad reasons. Until that's figured out, Blackstone been rallying in anticipation of more generous rate cuts for the good reasons. And now we see perhaps all of the good news priced in this case. The chart is trading at the upper Bollinger Bands. The MACD is overextended. So is the RSI in overbought territory. And we see the Vortex indicator, the bullish momentum, already opening a massive gap against the bearish. But is it topping? Is it a point of reversal? Possible. No confirmation yet. But the question becomes, is it a good point for entry when you're looking at a chart like this? The answer is absolutely not. The risk is actually that this chart could reverse at this point because the phenomenon of sell the news, any confirmation that the rate cuts will be for a bad reason, or even just sell the news by itself, could impact this chart negatively. Another example is a chart that we talked about before the Fed decision, that it's overextended, pricing in the good news. Look at commercial real estate, Vornado, VNO, weekly chart. Again, the upper Bollinger Bands. The RSI is overbought. The MACD is already overextended. The Vortex indicator already played in the bullish momentum to its pretty much full extent right now. Maybe you can squeeze a little more. But again, the question goes back to good entry or not a good entry. The answer is not a good entry. Okay, so how do we deal with a chart like this? If you're bearish and you're dismissive of the 50 basis points cuts because they're happening for the wrong reasons, or we're going to see a sell the news phenomenon either way. And this is one chart that you're going to pick against. You're going to look at it as an opportunity to pick against, not to chase to the upside. So if you're doing a balanced approach, maybe you go along the KRE and then you go short, Blackstone or Vornado, where we've seen the 50 basis points already priced in. Let's look at another risk on, the IYT, Transportation ETF. Now, you look at the MACD indicator, it looks pretty good. It looks as a reversal from bearish to bullish underway. You look at the Vortex indicator, same thing. It looks as we have bullish momentum accelerating. But that closing of the week, that candle, looks pretty ugly. It looks as a reversal candle. What the hell is going on with the IYT, the Transportation ETF? The answer is it's not a black and white story either. So you can look at Jets, the airlines ETF, and the airline has been doing phenomenal. Then you can look at what happened with FedEx, big weighting in the IYT. FedEx went down by double digits on Friday based on the bad news, and it impacted the IYT negatively. But the ETF itself is still looking bullish. In other words, if you believe that the rotation will be good for the cyclicals, and maybe you believe that, hey, the rate cuts are happening for the wrong reasons, but until we get a proof point that says, yes, the Fed is doing 50 for the wrong reasons, between now and then, we will see a risk-on rally. I'd like to pick on some cyclicals here. Where is the opportunity? The opportunity, IYT, perhaps not the ETF, because you're going to have stuff like FedEx. And then you look at another component like Jets, the airliners, and maybe those already priced in. They already rallied ahead of time. But then you look at other components in the IYT and transportation, and you find opportunities. So again, I'm giving you the general look here. We'll expand on this conversation in Discord. So I'm going to say here, folks, remember when we talked about the IYT, and it looked as a good-looking chart in the weekly, but we have to pick the good, the bad, the ugly. We got to show you the good, the bad, the ugly. You pick the good, of course. You avoid the bad and the ugly. and you're not going to chase something that already priced in the good news. So this is what we're going to do in Discord, and I gave you those examples when we did the IGV, the SMH, and the XLK. But like I said, if I do it for every ETF here, this video will last for hours. So we'll expand on this conversation in Discord. But I'm just giving you the general view that this is a picker's market. This is not a lazy market anymore. Now let's look at a risk-on category that perhaps didn't price the good news. It's actually pricing bad news. It's pricing 50 for the bad reasons. And in this case, it's XLE Energy. If we look at this chart here, weekly chart, it is at the lower Bollinger Bands. If we look at the candlestick, if we look at the MACD indicator, it's been under bearish momentum since the summer. But the question is, are we about to see the bearish momentum shifting into bullish momentum? And the answer is, it looks likely. We know that's going to be the next step, just a matter of when. You look at the Vortex indicator, it's the same thing. It shows that the blue line is firming up. The red line is losing momentum, meaning the bulls, energy bulls in this case, are beginning to creep in. What else can we see in this chart? We have, perhaps if we remove the Bollinger Bands, we have a consolidation pattern. The channel is descending. Is there a probability that we could see a break to the upside? The answer is absolutely. And therefore, when I look at the risk economy, look at the Vortex indicator once again, if we expand this here, you see that the bearish momentum is trending down, bullish trending higher. No confirmation yet, no crossing, but what is the risk right now in the XLE and energy? The bears been dominating, but maybe they're running out of time, and the bulls are beginning to creep back in because rate cuts, historically speaking, are pretty good for energy. And the last time we've seen a crossing in the Vortex indicator where the blue line took over the red was back in the beginning of the year. And during that phase, if we go back to the chart, since the cross in about February 24, we've seen the XLE, the energy ETF, rallying by double digits, about 15.5%. So again, not a black and white story, folks. When we talk about risk on, you might not be convinced that the XRT is a good pick yet. You might not be convinced that Vornado or the commercial real estate or Blackstone is a good pick because it already priced in the good story. But then you look at the opportunities, or maybe the KRE is beginning to recover, at least in the period between now and until the bad news hit. And then you got the XLE, which hasn't priced any good news, but it's readying to do so. And we know the rate cuts, good reasons, bad reasons, doesn't matter for energy. Energy loves rate cuts. So if I'm looking at the risk-on categories, I'm picking what I like. KRE, XLE. I'm going to stick with my airliners that I bought recently, and that's about it. I'm not going to chase anything that I'm not convinced, at least not yet, that it's going to be a benefactor of the rotation. And that's what you should do. You should look at the charts and pick your names individually. You pick what you like, what you're convinced of, whatever assumption you got. Whether the assumption is, hey, it's going to be a good period between now and the bad news, or between now and reemergence of inflation, or we're going to get bad news right off the gate next week, and that's going to do something against Blackstone or Vornado, or whatever names you're looking at. You gotta look at the charts and pick your own narrative. It's not a black and white story anymore. It's not everything goes higher together, or everything goes down again together. It's an individual game now. And lastly, since we talked about technology with its components, chips, XLK, big caps, and software, and we talked about risk on with its, at least not all, but at least some, or the majority of its components, let's talk about risk off. And here we're talking about, of course, names like utilities, staples, mostly dividend-paying names, value kind of names. We call them risk off because folks migrate to these kind of names when they're looking for safety, when the market shows uncertainty, we have macro data conflicting and maybe turning bearish or negative, then these names become a resource of safety. And you'll notice when we look at these charts, they've been leading the market since the month of August. But the main question now becomes, did they price in the good news for these names? Because if we have rate cuts 50 basis points for the wrong reasons, these are the kind of names you want to be in. But like I said, folks, between now and the proof showing up that the Fed did the 50 basis points for the wrong reasons, you might see a good period in the market where risk on benefits from a rotation. The question is, where will this rotation come from? Let's look at some of these charts right here. We begin, for example, by the IYR. Real estate, of course, again, not a black and white. Within real estate, there's the Vornados of the world. There's the offices, the apartments, all of these REITs that are under risk. But then you have the safeties. You have the public storage. You have the American Tower, dividend-paying names. Those are the heaviest weight in the IYR. So it's been a benefactor when folks rushed to the safety this summer. But as we said in the last video for the members, that the IYR is under threat of sell the news. It already priced in the 50 basis points. It priced them in for the wrong reasons. Now the market is looking at it as, 50 for the good reasons, at least for now, transitory period, until the proof comes that no, the Fed did it because they're panicking about the economy. Now, remember, folks, I told you that these kind of charts, the value, the dividend-paying names, those are the new big caps. Those are the most reliable charts that you should stay long. But you have to hedge because now they got way overbought and they priced in the 50 for the wrong reasons. Now we're playing 50 for the good. So they pull back. They give you the opportunity for those of you who are not in these kind of names to enter. So we should embrace any pullback we get from these kind of names. We should embrace any rotation we get out of these names into risk on. We can play risk on for a little while, but at some point we will be hit by the bad news. Are we going to go back to these names once again? Keep that in mind. But right now, good entry for the IYR? Of course not. It's the upper Bollinger Bands. Look at the RSI, already overbought. The Vortex priced in the good story. The bullish momentum already played out to its maximum ability at this point. And the risk becomes that we get a pullback. You look at the XLP staples. Once again, similar looking chart at the upper Bollinger Bands. Now finding some rotation where folks are booking the profits and they're buying some risk on. You see the momentum indicator in the MACD already at the max. The RSI overbought. The Vortex already played the bullish momentum to its max. So the risk in this chart is a rotation out of it toward risk on or the big caps or whatever the market decides to choose. But again, the pullbacks in these kind of names, opportunities to buy, because you're going to find out sooner than later that the rate cuts are happening, but they're happening for the wrong reasons. They always do, no matter how many lies the Federal Reserve tries to tell us that, we're just doing the 50 because inflation is going down. Nobody did that in the history of the Federal Reserve. And every time they did it, it was proven to be a mistake. They cut rates either because they've made a mistake in raising them, case in point 2018, or because the risk of recession is increasing dramatically. And doing 50, not 25, is saying that the risk of recession is huge. Keep that in mind. Looking at the XLU utilities, another safety dividend-paying ETF, at the highs, above the upper Bollinger Bands, the MACD's way overextended, the RSI way overbought, the Vortex indicator already played the bullish momentum to its max. And of course, we got some good news Friday from Constellation Energy, that they're now providing nuclear energy to Microsoft to power AI. So you notice how the AI mania is evolving now. And we're not looking at the chip designers, the NVIDIAs anymore. We're looking at water cooling. We're looking at nuclear energy. Soon enough, we'll be looking at oil to power all of these data centers. Interesting, isn't it? But anyways, good for utilities. But boy, wouldn't you love to see a pullback here? And I think, regardless of the good news that we got Friday, you will see money coming out of these names, the utility names, and rotating toward risk on. Until the bad news hits, then we go back to the XLU. So we want to see a pullback here. A pullback is a pretty good thing in the XLU. And it goes with the same token. Do you enter the XLU right now? Johnny come lately? Of course not. We talked about these names and these themes months ago, that you got to go with a rotation toward value, dividends. The time for that is over. Now the rotation will probably be risk on or to the technology names again, at least some of them. And speaking of tech, when we talk about safety and risk off, look at IBM. Value, check mark. Dividend paying, check mark. AI play, check mark. And this is why IBM is already at the highs. It's trading way better than any of the big caps. It's trading way better than any of the chip names because of these two reasons. It actually fits three categories. And that's why it's outperforming even utilities, because it's not only safety, it's not only value, it's not only a dividend-paying name, it's also an AI play. The question now, if you've been investing in IBM and the chart is looking like this, at the upper Bollinger Bands, RSI way overbought, MACD, Vortex indicators all priced in, all of the good news, all of the bullish juice has been squeezed out of this name. Is it a good entry? Of course not. It's a point of profit taking. And if there are any charts at the risk of profit taking, would be these kind of charts, where folks are going to take the money and rotate towards something else. So keep that in mind. Not a good chart to enter, but perhaps a good chart to buy. If we see a pullback, we get hit by bad news, and then we kind of rotate back to value dividend paying names. And here's the last example of risk off. Let's look at telecoms. AT&T is a good example. Weekly chart. We talked about this, by the way, in the last video that we've done for the members. And if you guys listened to what I said, you would have made money without me. But unfortunately, a lot of you don't. A lot of you are just too lazy to look at these videos and the countless minutes. I give you almost an hour worth of content every day. If you skip, you lose. Because we talked about all of these names exactly. We talked about Philip Morris, for example, pulling back, and Coca-Cola and all of these names. Anyhow, AT&T, it fits the same bill. Value, check mark. High dividend paying, check mark. It's the kind of stock you want to own when things are uncertain. Now the Fed gave you 50 basis points, allegedly for the good reasons. Then you no longer need AT&T, which is trading at the upper Bollinger Bands. The MACD is overextended. The Vortex indicator played the bullish momentum to its max. The RSI is overbought. The risk in this chart is money coming out to chase something else. Not a good entry, but a good chart to keep an eye on. That when we pull back, it's just a matter of time before we get the bad news. Once we get it, we're going to go back to appreciating these names once again. And folks, that leads us to the conclusion of this video. Once again, accept my apology for the absence this week. It couldn't be avoided. We'll be back with the weekly recap tomorrow, which will include, of course, Monday's analysis. And then, of course, we got bonus videos. I finished a lot of them while I was staying here. And they'll go for the members, for the Discord members. We have exclusives for the Discord members only. So we'll get these videos to you as soon as tomorrow. No more delays. Keep an eye. Stay in touch. Stay with us. We'll be back. But this is all I got for you for now, folks. Thank you for listening. Thank you for watching. Hope you got a great weekend. And I will talk to you again soon. Take care.